It isn't enough to just know how to trade. You also have to employ time-tested techniques which stack the odds in your favor so you can consistently win. Now we return to our session.
Welcome back to our program. This is tape 2 in our interview with Don Fishback, who is a new options wizard. And Don, we've been talking about calls and we've been talking about basis of options, but now let's talk about puts.
Okay, Ron. In this example, what we're going to do is we're going to take a hypothetical example. Let's just say you're not so comfortable about the market prospects because it's May, and you've done a little bit of research. You found, and the folks at Yale Hirsch, at the Hirsch organization, has found that there's some seasonal weakness over the summer. Yeah, it's popular out there to talk about the potential for the summer rally,
yeah.
But it's not. Research actually shows that that's not necessarily the case. In fact, their research shows that since the 1950s, if you invested $10,000 from the period of May 1st through October 31st, the summer and early autumn period, your account would have grown from $10,000 to just $18,000. On the other hand, if you invested from November 1st through April 30th, your account would have grown to, and I had to look at this number,
from $10,000.
$10,000 to $227,000.
18,000 or 200,000? I'll take the 200.
Right. So the market has, this is the demonstration that during the November to April period, the market tends to do real well. May through October, it tends to not do so well.
Underperform.
Dramatically. So you want some protection for the summer. And one of the things that you can do, remember, puts tend to go up in value as the market declines or the asset declines. In this instance, you want some protection. And you want to buy a put. In this particular example, we're going to look at a new index. This is the DJX. That's the new Dow Jones Industrial Average Index. We're looking for protection over the summer and through the third Friday of September. Okay. This is through the third Friday of September, so there's the September series. 92 is the strike price. What that represents is 9,200 on the Dow Jones Industrial Average. And then the put is priced at 5 1/4 or $525. 5 1/4 times $100 per point is $525. In this instance, you need the market to go down. You're bearish. And you need volatility to be pretty good.
Okay.
I mean, if it just trickles down, you're going to lose money. And we're going to show you exactly why.
All right.
In this instance, the Dow Jones Industrial Average, you can see right here, the Dow Jones Industrial Average was at 9167.5.
All right.
That means the Dow Jones the DJX index was at 9166. That's pretty close to this divided by 100.
Right.
The put was at 5 1/4, and we're looking at the 92 put. So that means, remember what our break-even exercise is on a put.
Right.
It's the strike price minus the price of the option. 92 minus 5 1/4 is 86 3/4.
Okay.
So 86 3/4 times 100 is 86.75. At expiration, the Dow needs to be below 86.75 in order for us to make money. So it needs to drop. What is it? That's about 500 points over the course of the summer. Now, if it drops sooner than that, we'll show time value. It doesn't need to be that severe of a drop. But if you hold this thing for the life of the option, it really needs to drop pretty big. That's what we mean by you need that big volatility. It just can't go down. It has to go down big.
All right. So this is protection in a bear market.
Yes.
And you're using seasonals a little bit, seasonal studies to determine whether or not to do this.
Right. And this, again, this is just hypothetical. Just in case somebody who follows Yale Hirsch's stuff says, boy, that makes sense, I better do this. You can see at 90, the option will be worth 2. Now remember that 90 represents 9,000 on the Dow. So the option will be worth 2. We will have paid 5 1/4. So we will have lost 3 1/4 at that point. If the Dow were to, what's that? A 20% correction would be about 1,800 points. Let's just say 1,800 points. 1,800 points lower would be 7,300.
Right.
So if we got a 20% correction, that would be, let's just use this 74 as an example, because that would be less than a 20% correction. The option would be 18 at that point, which is 92 minus the 74.
Right.
5
what we paid
1/4
for it.
is what we paid for it. So we would have had a profit of 12 3/4, or that's $1,275 for every $500 that we spent. So you're making money as it goes down. And I just want to be absolutely sure, because we didn't go through this real
Right.
specifically.
Okay.
If it goes to 74, you have the right to sell it at 92.
Yes.
So you could buy it at 74 and sell it at 92, thereby getting an 18-point gain.
Right.
And that's where that value of 18 right here came from.
Right.
So that's
And then we just
One-
netted it out by
and we just-
subtracting the premium that we paid for the option.
exactly. And this is what the thing looks like. And you can see we're right at this point. We are somewhere right in here
As we record.
as we are right at this point
Right.
of the analysis.
Right.
So if the market stands still, we're going to lose some money.
Right.
And we're not going to lose the entire investment. We're going to lose some money. But if we do get the correction that we see, or that we're concerned about,
Right.
we're going to make a lot of money. Now, the reason this is called a protective put in this instance is our stocks are going down in value, or our mutual funds, and the put is going up in value, so we're getting protection. And if the market goes up this way, our losses are capped. But we would have a line going this way representing our mutual fund investments
Right.
that are more than offsetting
Right.
the losses in the option
So
part.
it's almost like a true hedge.
It is.
It is.
And you can get a 100% hedge or a 50% hedge depending on how how concerned you are.
Right. Right.
I mean, think of this as insurance. In fact, here's your deductible right there.
Yeah.
The
that's
92
right.
is your deductible. And what do we call the price of the option?
The premium. Yeah. It's just like on insurance. Yeah.
Insurance. And every insurance contract has to be renewed at the expiration of the contract. Well, there's our expiration. In fact, even the analytical principles that are used to value options have similarities to insurance. We're going to use volatility as our actuarial table. Exactly. So you're going to, it's very, very, I said at the beginning, is a very common element with insurance. Even the terms that we use have similarities. Well, that's a put.